Ever pondered on how to boost your cryptocurrency investments by 1,000 to 5,000% within a year? Welcome to the Quantum Crypto Path, a unique system designed to skyrocket your crypto returns. The Quantum Crypto Path is your gateway to creating financial portfolios with coins predicted to have exponential growth in the coming year. But how does it accomplish this? The secret lies in the advanced neural network at its core. This neural network diligently combs through the digital marketplace, sifting through an array of coins using a variety of criteria. It takes into account factors such as volatility, social media mentions on platforms like Twitter, and even the ability to read order books on the exchange. In essence, the Quantum Crypto Path is your intelligent assistant in the complex world of cryptocurrency. Guided by a neural network, it helps you make informed decisions in crypto investment. So, are you ready to embark on your quantum crypto path? Now let's delve into how the neural network aids in coin selection. The neural network is a complex system that mimics the human brain's functionality to make decisions. In the world of cryptocurrency, it can collect a list of coins through browser filters. It selects these coins based on a myriad of criteria, such as their volatility, their mentions on social networks like Twitter, and their ability to read order books on the stock exchange, among others. The neural network doesn't just select coins at random, it predicts the growth of certain coins, helping you make informed decisions about which ones to invest in. Now imagine you've started buying these coins, each with equal conditions in the portfolio. The network controls the entire purchasing process, ensuring efficiency and minimizing errors. The process doesn't stop at purchasing. When transferring coins, you make a profit. At this point, a new process of selecting coins occurs. The neural network filters pools into 4 categories: stable coins, blue chips, medium risk, and high risk. This way, it ensures a balanced distribution of risk and reward in your portfolio. Through this intelligent system, the neural network allows you to build a portfolio that's not just balanced, but also profitable. It's like having a personal financial advisor that's working around the clock, making complex calculations and predictions to maximize your profit potential. Through the neural network, you can build a balanced and profitable portfolio. Knowing how to allocate assets is critical in crypto investment. Our model suggests a balanced approach. Let's break it down. First, allocate 15% of your portfolio to stablecoins. These digital currencies are designed to minimize price volatility, the safety net amidst the market's wild swings. Next, dedicate an equal share, another 15%, each to Ethereum and Bitcoin. These are the blue chips of the crypto world, reliable and steady. Now the largest chunk, 30%, goes to Layer 1 altcoins. These are the foundational cryptocurrencies that host their own blockchain networks, and they offer a good balance of risk and reward. Finally, reserve 25% for high-risk assets. These may include new projects, NFT drops, and other ventures at the cutting edge of the crypto space. While risky, they can also offer substantial returns. With a well-structured asset allocation model, you can navigate both bull and bear markets with ease. Let's look at some portfolio examples to better understand how this works. Imagine you're setting up your portfolio in a bull market. You might want to balance it with 15% in stablecoins like UST, a crypto dollar project from Terra Luna which boasts full decentralization. Then, another 15% each in Ethereum and Bitcoin, our trusty blue chips. Layer 1 altcoins could take up to 30% of your portfolio depending on your preference. I'm partial to Luna and AVAX, and I also hold BNB, the native coin of Binance. Lastly, allocate a daring 25% to high-risk assets like new metaverses or play-to-earn games. Now let's picture a bear market. Your portfolio might look a little different. You'd want to increase your stablecoins to 40% to mitigate risks, while maintaining 15% each in Ethereum and Bitcoin. The allocation for Layer 1 altcoins remains the same at 30%. In both scenarios, high-risk projects should be approached with caution, making up no more than 5% of your total portfolio. These could be NFT drops or new gaming platforms. But remember, always do your due diligence, read up on their tokenomics, check their social media presence, and find out who's backing them. By carefully analyzing and selecting coins, you can build a profitable portfolio and significantly boost your crypto investments.